And so the next question we're going to be going over is lower of cost or market. Now, no, this is a little outdated. There's the new concept for the new accounting rules is called lower or cost or net realizable value. But you're going to learn about this as you go through your accounting career. So I just want you to understand the concept, and then you can use it under the new methodology. So the real concept here is what I should be able to, I should only report on my books the value of my inventory if the market price of that inventory isn't less. And so how do we define that lower cost? They're saying the replacement cost here, it's called net realizable value now. The definition has changed a little bit, but we'll just know this for your book because this is what you'll be tested on. And so we can apply this from an accounting policy depending on how complex the business is. You can do lower of cost to market for like individual items, a major category of items, or for your entire inventory. You can do the assessment at aggregated at different levels based on what makes sense for the business, as long as you're accurately reporting the information. And so here's a thought. Let's say we're doing it by inventory items. Let's say we have Roadster, Sprint, and we have our total costs here and our total market here. We can either do it by these individual items or the total. Let's say we're doing it by the total here. We would have to reduce the total costs on our books to $190,000 because our market value is so much less, right? So here we're saying we purchased it for $220,000, but now it's only worth $190,000. We're going to have to make an adjustment for whatever it's worth at the end of every reporting period because it's no longer worth $220,000. It doesn't work the opposite way. If the value goes up, we don't get to make a fair market value adjustment up. We only take it down. So investors are aware. Think about it, if let's say I owned a bunch of CD players. No one uses CDs anymore, right? It would be unfair of me to tell investors I had inventory of $1 million if they're all CD players. I would have to write them to what their market value is, which would be zero. So I would expense all of that as a lower of cost or market adjustment. So let's use this as an example. A company has the following products in their inventory: road bikes, mountain bikes, and town bikes. Let's compute the lower of cost of market for this if it's applied separately to each product. If the lower, and so make sure you understand that the question I could ask you if it's applied to each product or if it's applied to total inventory, right? So make sure you're looking at the question carefully. And so if I'm doing it by product, my cost is $5,000 for the road bikes, $2,000 for the mountain bikes, and town bikes is $4,000. And so let me do Google Sheets here. I think this will be helpful. So this was inventory, FIFO, etc. And then I'll put here lower cost, LCM, lower cost or market. So what are we doing here? We have road bikes, mountain bikes, and town bikes. There's a reason I'm doing this with you is I want you to see the difference per unit cost, market. Five, 4, 10, 1,000, 500, 400, 800, 600, 450. Total. Here, this is how you'd go about doing it. Our market would just be the units times the cost per market, or the price per market, and then we'd say difference. If cost is greater than market, right, we're okay. So we don't have to worry about that. And we sum it. So I can ask you two questions here. We can see that I'll do the first one. What if we do it by item? If we're doing it by item category, let's see, total adjustment. Oops. Sorry, I have to reverse market. If I'm doing it by item, my adjustment would be 1,000, right? And we'd adjust it by cost of goods sold for 1,000. And we reduce our inventory by 1,000. Why, right? Cost of goods sold is what kind of account? Our cost of goods sold is an expense account. It has a normal balance of a debit. I don't want us to forget this. You have to know this information by this time in this course, right? Cost of goods sold is a debit, normal balance. Debits increase it. That's going to reduce our profit and our income. Our inventory is an asset. Our inventory is going to be reduced by a credit. We're adjusting it because our market value is less than what we purchased it for. But what if I asked you to do it total by inventory? Total adjustment by inventory. What would be the amount? It's a question for the class.
5,000.
What?
Would it be 5,000?
Nope. Good shot though. What would be the total amount? Good job, Griselda. 100. If I asked you to adjust it for the whole inventory, it would just be this 100 amount. Cost of goods sold in inventory. If we did it for the total inventory. The reason being, so the 500 was a good shot, but the reason being is we're not looking at the total cost here. We're looking at the total adjustment from market and total cost, and determining if our market is lower than our total cost, then it will be 100. Then we'll adjust it downward. So we're saying here, if we look at the sum, we paid 1,100. The market value is 10,900, and so instead of 11,000, 10,900, our market is worth 100 less. And so that's where we got to be careful. Is I can ask you to do this by item or by the total inventory value, right? And so just make sure that you're aware of how we're assessing this in your midterm and in your homework. Any questions there? Cool. So this is key to start thinking analytically, right? So now after this, you should know how to do the reporting. And now we should know also how to do lower of cost of market reporting. Next thing is what happens if we have some errors in our inventory. So realize how everything is interconnected. If my ending inventory is understated, so let's say my inventory is, I've reported too little inventory, I'm going to overstate my cost of goods sold, right? Because that inventory goes to cost of goods sold. I'm going to understate my income because we're going to have too much cost of goods sold. And then in year 2, we're going to flip that. Because we recognize too much cost of goods sold in year 1, we're going to impact year 2. There's going to be less cost of goods sold for year 2. And so this is where we have to be very careful is if we mess up 1 year of income, it'll, especially with inventory, it affects all future years. And so you remember me saying probably in my first class, second lecture, maybe third, is I don't like inventory. I'm not a fan of this accounting. It's not that the accounting's wrong. It just becomes a very detail oriented and very challenging process to make sure that we're tracking all of this correctly. And if there's an error in one period, it flows through to all future periods. So you have to be very careful related to inventory. Inventory is not my favorite business. I prefer service businesses or software businesses. And so make sure we're always realizing that the inventory could impact, if we understate inventory, it's going to understate our assets and equity. And if we overstate inventory, it's going to overstate assets and equity in that period. And then every period after, it'll negatively impact it.